Your cash can earn interest in more than one place, but a high-yield savings account, a Treasury bill, and a money market fund are not the same thing. When yields still look attractive, a lot of people ask the same question. Should my spare cash sit in the bank, go into T-bills, or move into a brokerage money market fund? The answer is less about chasing the highest number and more about what that cash is for. All three are usually used for money you do not want exposed to stock market swings. Emergency funds, tax payments, house down payments, tuition money, and cash waiting to be invested all fit that category. But each option has a different mix of safety, access, tax treatment, and rate behavior. For years, cash felt boring because many accounts paid almost nothing. Then, interest rates rose, and suddenly, cash started paying real income again. Even after rate changes, many savers are still seeing yields that are high enough to pay attention to. Think of the three choices like 3 parking spots. A high-yield savings account is the easy parking spot, right by the door. A T-bill is a reserve space with a set pickup date. A money market fund is a parking garage inside your brokerage account. A high-yield savings account is simply a savings account at a bank or credit union that pays a higher rate than a typical branch savings account. It feels familiar because it is still a deposit account. You put dollars in, the bank pays interest, and you can usually transfer money out when needed. The biggest strength of a high-yield savings account is deposit insurance. At an FDIC-insured bank, eligible deposits are generally insured up to the coverage limits. At an NCUA-insured credit union, similar coverage applies. The key is that the account must actually be an insured deposit account. The common number people know is $250,000 per depositor, per insured institution, per ownership category. That wording matters. 2 accounts at the same bank do not automatically double your coverage if they are in the same ownership category. For emergency money, the access is the main selling point. You can move funds back to checking, often within a day or a few business days, depending on the bank and transfer method. Some accounts also offer ATM cards or internal transfers, but the exact speed depends on the institution. The trade-off is that the bank controls the rate. A high advertised APY can change. Sometimes it changes quickly. Sometimes it lags behind the broader interest rate market. That means a high-yield savings account is convenient, but it is not a guaranteed long-term rate. A Treasury bill, often called a T-bill, is short-term debt issued by the United States Treasury. You are lending money to the federal government for a short period, often a few weeks to 1 year. Instead of receiving monthly interest, you usually buy at a discount and receive face value at maturity. Imagine buying a $1,000 T-bill for slightly less than $1,000. When it matures, you receive the full $1,000. The difference between what you paid and what you receive is your interest. The exact price and yield depend on the auction or market price. If this kind of plain English money breakdown is useful, consider subscribing. The goal here is not to hype one product. It is to help you understand the trade-offs well enough to make better cash decisions for your own situation. T-bills are not FDIC insured because they are not bank deposits. They are direct obligations of the US government. That is why many investors treat them as extremely high quality. But the protection is different from deposit insurance, and the details matter if you buy through a broker or Treasury Direct. If you hold a T-bill until maturity, the access date is clear. The money comes back when the bill matures. If you need the money before then, you may have to sell it in the secondary market. For short T-bills, price movement is usually small, but it is not the same as instant cash. A common approach is a T-bill ladder. Instead of putting all cash into one maturity date, you split it across several bills. One matures soon, another later, and another after that. This can create regular access while still letting parts of the cash earn the bill yield. T-bill interest is generally taxable at the federal level, but it is usually exempt from state and local income taxes. That can make a difference for savers in higher tax states. The best choice is not just the headline yield. It is the after-tax yield you actually keep. A money market fund is not a bank account. It is a mutual fund that invests in short-term, high-quality debt. Depending on the fund, that may include Treasury bills, government agency securities, repurchase agreements, certificates of deposit, or commercial paper. Money market funds are designed to be low-volatility cash management tools. Many brokerage accounts use one as a place for uninvested cash. The fund tries to maintain a stable $1 share price while paying income that moves with short-term interest rates. This is where the naming gets confusing. A money market account is usually a bank deposit account, often insured if it is at an insured bank or credit union. A money market fund is an investment product. Similar name, different legal structure, different protection. Money market funds are not FDIC insured. If held at a brokerage, they may have SIPC protection if the brokerage fails and securities are missing. But SIPC does not protect you from investment losses. That distinction is one of the most important misunderstandings in cash management. The phrase people worry about is breaking the buck. That means a money market fund's share price falls below $1. It has been rare, but it is not impossible. Government money market funds are usually viewed as lower risk than prime funds, which may hold more corporate short-term debt. Now, let's compare how fast the rates reset. A high-yield savings account can change whenever the bank changes it. A money market fund's yield usually adjusts quickly as its short-term holdings mature and get replaced. A T-bill locks in its yield if you hold it to maturity. Fast resetting can help when rates rise, because your yield may catch up quickly. But it can hurt when rates fall, because your income can drop quickly too. Locking in a T-bill can feel nice if rates fall after you buy, but less nice if rates rise right after. The highest number on the screen is not always the best choice. A savings account shows APY, which includes compounding. A T-bill yield may be quoted in different ways. A money market fund often shows a 7-day yield. These numbers are related, but not always perfectly comparable. Costs also matter. Many high-yield savings accounts have no monthly fee, but you still check rules and minimums. T-bills bought at auction often have no commission at major platforms, but spreads can matter if you sell early. Money market funds have expense ratios already reflected in their yield. For a true emergency fund, simplicity is valuable. If the car breaks down or the water heater fails, you do not want to think about settlement dates or market hours. That is why many people keep at least the first layer of emergency cash in an insured high-yield savings account. A layered emergency fund can make sense. Maybe 1 month of expenses stays in checking or savings for instant access. The next few months sit in a high-yield savings account. Extra reserves, if you have them, might be in short T-bills or a government money market fund. For a short-term goal with a known date, T-bills can be useful. If you know a tax payment, tuition bill, or house closing is due around a certain month, you can choose maturities that line up with that need. The goal is matching the cash to the calendar. For cash already inside a brokerage account, a money market fund can be convenient. It may keep cash ready for investing while still earning income. The convenience is strongest when the fund is integrated into your brokerage workflow and redemptions are easy. For larger balances, protection structure becomes more important. With bank deposits, you may need to think about insurance limits, ownership categories, and spreading cash across institutions. With T-bills, you think about maturity dates and account access. With money funds, you think about fund type, broker safety, and investment risk. If you live in a state with income tax, compare after-tax returns. A high-yield savings account usually pays interest taxable at federal, state, and local levels. T-bill interest generally avoids state and local income taxes. Some Treasury-focused money market funds may pass through some state tax benefit, but it depends on the fund and state rules. Liquidity is not just whether you can get the money, it is when you can get it. Bank transfers can take time. T-bills have maturity dates and settlement rules. Money market funds may trade at the end of the day. For money due tomorrow morning, these timing details matter. There is also a behavior angle. If money is too easy to spend, a separate savings account can protect it from impulse purchases. If money is too hidden or complicated, you might delay using it in a real emergency. The best cash setup is one you can actually manage calmly. Before moving cash, check 5 things in plain English. What is the current yield? What is insured or backed and what is not? How fast can I access the money? What taxes apply? And what happens if rates move down or up next month? There is no universal winner. A high-yield savings account often wins on simplicity and insured access. T-bills often win for date matching and state tax treatment. Money market funds often win for brokerage convenience and fast rate adjustment. The right answer can be a combination. A practical beginner setup might look like this. Keep immediate emergency money in checking and high-yield savings. Use T-bills for known expenses with clear dates. Use a government money market fund for brokerage cash you may invest soon. Then, review the setup when rates, goals, or balances change. The real question is not which cash vehicle sounds smartest online. The real question is what job each dollar has. If the job is instant safety, favor access and insurance. If the job has a date, match the maturity. If the job is brokerage flexibility, understand the fund before using it. If you still have questions, leave them in the comments. Tell me which cash option you are trying to understand, or suggest the next money topic you want explained in plain English.